Hey fellow option traders, this is Jeff and welcome to the 510 Iron Condor. Now for those of you who watch my daily scans, you may have caught some of this on previous videos, and I don't remember exactly what days I might have talked about it. I actually opened one on Chipotle, which we will review later. But I wanted to just do, I did a post on my blog and I wanted to do an accompanying video with it to just give you a little bit more detail on what I'm doing here. I'm going to reset my slices and just show you where my thoughts are headed here. Okay, so right now I have a simulated trade set up here on Amazon with a May expiration. But before we actually go into where I was coming from on that, I want to show you how to set these up using the Thinkorswim platform, how to find out where your 5 and 10% probability lines are. So we'll go to the risk profile first, and we are interested in the May expiration right now. This is what we're going to focus on for this example. So just to make sure that we're in the right place here, we set our probability date to May 18th, which is actually when the options expire. They actually expire on that Saturday. So we select that date, and then we take our price slice here and we just slide it out until, watch this number up here, we're going to want that number to go down to 5%. So on the put side, on the downside, we want to be at 5%. Now I tried to do this using deltas, but the delta is just not reliable enough because of IV. If you have the IV on some stocks is higher and some are lower, and so therefore it kind of skews the delta one way or the other. So it makes it hard to say, go for a 5 delta or a 10 delta or something like that. I tried to do that, and I thought it would work, but when I went around and checked different stocks, it didn't work. I found this to be the most reliable way. So on the 5% end here, we end up with 209. So we would say, well, let's pick a 210. So if we go down here and change this to 210, and we'll get a 5.34% probability that a 210 May strike will expire out of the money. Put strike. Let me say that again. Let me restate that. There's a 5.34% probability that a May 210 put will expire out of the money. Now that's a pretty good probability. I mean, where else can you, and it's just probability, and it's based on the current price and all that stuff, but where else can you get a probability like that on any sort of trade that you might do? There's not many places. So we do the same thing for the call side of our Iron Condor. We drag this out here until we get to 10%, and then we look for, well, what's the closest strike? Well, actually 295 is, so we can change this from 294.06 to 295, and we end up with 10.01% probability that a May 295 call will expire out of the money. Okay? So then what we do is we just simply go over to the add a simulated trade, and we want to I was messing around with some other months here, and we want May, since we get up here to May, and we just simply pick the strikes that we want. We want a 210, so we just go to the 210 put, and we say I want to sell a vertical, and it shows up down here. I'll take these two off just so we don't get confused here. And we said on the call side that we wanted a 295. Actually, I could have just looked right down here, 295. So that's what we want on the call side. So we go to the 295 and we say we want to sell a vertical. All right, so now we have actually a total credit here of 64 cents, I believe. Let's check this out. 64, no, 59, because I've clicked to include commissions here. So I want to be honest with everybody, and we are going to include commissions when we figure these things out. And then I said that we would put at risk no more than 25%, but we probably will just shoot for 25% each month. So if we do that, then we can actually, because this is a $5 spread, we can actually put 5 of these on, 5 lots. So we'll change this to 5. And we look up here and we're looking at, including commissions, $295 in credit when we open this trade, with at risk is 2205. Now when I did my calculations, I just did them scratch. I didn't like subtract the credit that I'm getting and all that kind of stuff. I wanted to actually show a worst case scenario. So Thinkorswim won't let you, holds this aside, this 2,500, so you can't spend it. So you might as well say that it's gone, but we still get this credit. So the credit is $295. So in reality, our at risk is 2205. But that's just splitting hairs. So for right now, I'm going to just stick with what I got. Okay. So that's how you set this up. Now, let's take a look at another example. You say, well, maybe, April's still 2 weeks away, so I might want to still do an April. Well, let's take a look at an April and see what that would get for us. And you might be able to do these. I don't think it should go any more than 40 days out. On these 40 trade days. So if we look over here, we see that the Mays are 40 days out. I don't think you should go any further than that, because when I was looking at it, the returns just aren't there. They start to dwindle because you're so far out. There's also some other factors like earnings is coming up and stuff like that. So, where are we here? Well, there's a lot of dependencies. So just for funds, just for giggles, I guess you might say, let's go to April, and we will go to the risk profile and change our probability date back here to April 20th, and then let's go fishing around for our 5%. Alright, we're looking probably at like a 230, so we'll change that to 230, and this one, 10%, 10%, it's falling right in the middle. Don't really like that a whole heck. I don't want to go back to 275. Not feeling real comfortable about that. And I don't want to go to 280 because I don't think there's going to be any money in it, but let's take a look at it anyway. So we're looking at 280 here. And we'll go back to our trades here and let's get those set up. We need a 230 on the put side. And we're still risking the same amount, $500 for each lot, and a 280 on the call side. That's right up here. So you can see that even though you're talking about a shorter time frame, there's just not enough credit in this. So we're going to go back to our original ones. I shouldn't have not have deleted those. I'll put them back in. We'll just go through it again here, the process here again, so that you can see repetition is the best way to do it, right? We're looking at May. Set our probability to May. Go down here to our 5%, 210, and our 10% up here. $2.95. Okay. Go back here to our May expiration, 210 and $2.95. Go back to the risk profile, bump these up to 5 lots. Oops. And there we have it. We have a possibility, a very good possibility, about a 92% probability that we will collect the full $295 on Amazon. So let's pop a chart here. Alright, so here we have the Iron Condor set up here. I have these yellow lines in here that show the spread between the Iron Condor. We're talking about a 210, which is really where this line is really on 210, and 295 is where this line is. Now, like I said in my blog, come on people, do you really think that this is going to move that much in this time period? Well, we have earnings coming up. Okay, let's look historically at earnings. Last earnings, yeah, there's a little craziness that went on in here, but is there actually a spread like this? And one way that you can look at this is to say, drawing, let's make a trend line. We'll take a trend line and we'll just like start it down here. This is the spread, right? Up to there. Now I need to take the ray off. Right ray? No. Okay. Okay, now we can take this trend line, oops, this trend line and activate it, and we can drag this around and say, where have you seen that spread at earnings? Well, here's earnings. Did we see that spread there? Nope. Here's earnings. Do we see that spread there? Nope. Here's earnings. Here's a big gap up here in earnings. Do we see that spread there? Depends on where the price comes in. Well, let's say we're here on the price, midpoint on this spread, which is about where my cursor is. Let's move it up there. That's about midpoint there. That's pretty close, but still it came back and settled down. So do we think that that is going to hurt us? Probably not. Probably not. I mean, it would have to be astronomical earnings one way or the other. Something just completely out of the ordinary. Even a big bear run or a big bull run, either or. Well, we all know that things go down quicker to the downside, which is why I made that 5%, or a 95% probability of being successful on that side, because you do get some very fast moves down. But still, I think we're pretty safe. So I have to go with my gut on that. Alright, so I did the same thing on Google and the examples in my blog. This is only going to give us $195, and why is that? Well, I did the same thing here. If I drag this here to, do we have the right probability date? May, okay. This is about 5% on this end, and this is about 10% on this end. And that is the credit that we're collecting. Why is that? Well, let's take a look. I believe Google's earnings are in the April expiration and not in May expiration. So Amazon's implied volatility is a little bit high because of that. So that's why May looks really good for Amazon and not so hot for Google, which is why when I did my chart, I said that, you know, you can do 11%, You can do 11% annually with collecting $100 a month. So on a $10,000 account. Nothing wrong with that. Hey, that's all I got to say. Okay, and then I wanted to show you, that's Amazon and Google, and then I wanted to show you Chipotle, which I put on the 27th or the 28th of April, or I mean of March. Back here on this date, let me zoom in here a little bit. Squish this down. So this is the date that I put this on, the 28th it was, and we'll take a look at how it's doing. Let's do hide simulations, and I have to change accounts here to go to the Profit 10 portfolio account. I'll move that back over here. Okay, we actually are collecting 300 on this, and why is that? Well, again, we have earnings just before expiration here, so the IV is inflated, which is fine. We'll probably be out of this before this earnings date, or we might just sit through it. Who knows? But the one thing that I wanted to point out to you, I've been in this trade for a week. I think it's a week. Let me look here. Back to, oops. I hit the wrong button. Charts. There we go. 1, 2, yes, actually I got into it a week ago Friday, so I've been in it a week. And if you look at the Analyze tab, the white line, which is the current profit and loss line, is just, well, it's up a penny now. Well, that day. It's down $20 yet. So as IV increases, this white line gets suppressed and it takes you longer to get to your max profit. So if IV is increasing, then that means probably that the price will be moving down. It also, options kind of figure from overall market IV as well, like from the VIX. And that's been, moving up a little bit lately. So it's been a little bit harder for get this white line above the zero line here. But that's okay because it's still not going to do anything to our profit. Don't care what the IV is. The profit amount is locked in, unlike a calendar. So we're locked, cocked, and ready to rock. Okay, so I think that's it. Did I want to say anything else about this? If you have any questions, you can always feel free to ask them either on YouTube or on my blog. I answer both. Although on my blog I am able to give a much more robust answer because I'm limited in characters on YouTube, and I can't put any links in, which is very frustrating. That's just really, anyway, that's neither here nor there. I manage somehow, and if it's too long, I might just write a post about it on my blog. But anyway, if you're only seeing this on YouTube, by all means go over to my blog and check out this particular post. It's www.theoptionguru.com/blog. Alright, so that is it. Thank you very much for watching. Have a great day and happy trading.